Hello, everyone, and welcome to TradeFinder Live. It's great to be back with you all during this trading day, trading week, and during this holiday week. I'll be introducing Mr. Rob Roy here in just a few moments, but first and foremost, we do need to cover off our disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Feel free to take a screenshot of that if you like. But that's the main point to take away. Other than that, the market's digesting the proposed Trump tariffs, which have been the topic of conversation of the financial networks today, and I'm sure they will be for the foreseeable future. I'm curious as to what Rob has to say about that and the market's actions post that. So also very excited to interact with you all. Thank you for joining us live. And at this moment in time, I'll introduce the man of the hour, Mr. Rob Roy.
Hey, Zach. Hey, everyone. Welcome to TradeFinder Live. Happy Thanksgiving week to everybody. As you mentioned, Zach, there's going to be a holiday shortened week. The markets are closed on Thursday for Thanksgiving and only open half a day, close at 1 o'clock on Friday. Typically, lower volume week with people taking the holidays off. I've talked about this in the past as well. We kind of are starting now. This week starts the lower volume, but not necessarily lower volatility time frame through the holidays into the end of the year. And the way that works is the investment managers that have beat their benchmark, which is the S&P. So if an investment manager has outperformed the S&P, they get their bonus. So they tend to just take the rest of the year off. And those that haven't will be chasing performance throughout the end of the year, trying to outperform the S&P so they can get their bonuses. But usually it's on lower volume. There's an old adage, never short a dull market. That's what that means. Lower volume is what they mean by a dull market because it's not as active from a volume standpoint. But with the lower volume can come increased volatility. So it's an interesting time to be trading as well. So, Zach, thanks. Let's go ahead and take a look at the chart of the S&P. We'll see.
Hey, Rob, can you flip your screen share over, please?
You think people want to see the screen?
Maybe. Maybe.
Perhaps. It might help.
Might help with the commentary, right? If you everybody's seeing what I look at. So there you go. There's the S&P. And you can see the movement to the upside here as we are still in the upper end of this pennant pattern, which could be an ending diagonal. And people have been asking, why are you saying it's an ending diagonal? Isn't it a beginning diagonal? And it is true that an ending diagonal usually ends with a wave 5. But we could come back down. I thought maybe where this B is, you can see I've drawn this new zigzag here, could be labeled a wave 4. It hasn't been yet. The algorithm still has the 3 is active. That's why it's green and not purple, like the 1 and 2 that are confirmed to be complete. So we'll wait and see. But we're at this upper end. Could we break out of it? We could. Would actually make a lot of sense. We talked about how there could be a blow off top at the end of a wave 5. Thought maybe that was it following the election, but nope. The LA wave algorithm says that isn't it. We're still in the wave 3. So maybe this becomes a 4, or maybe we pull down again. Be a little suspect of that at this time of the year. But as I said, with lower volume can come added volatility. So anything is possible. But for now, it looks like still maybe up to the 610 level, which we talked about way back with the other zigzags when we were still in a wave 5. We still could go to the exact same targets, which I find interesting with this complex move that's occurring. But Zach, you mentioned the tariffs, and that has been the subject, you're right, on everything financial, because Trump came out and was addressing the tariffs that he's going to put on Mexico and Canada and additional tariffs on China. And then the commentary from the talking heads has been the market seems to be thinking that with whatever tariffs come, it's probably not going to be as high as what President-elect Trump has been saying. At least that's how the market's trading it. It seems to be shaking it off, so to speak, which is just relaying what some of the Fed speakers said. I'm going to go to the bond market in a minute. We'll talk about what that's saying regarding it. There was a big move yesterday. We'll see what kind of follow through there was today, or has been so far today. Let's look at the VIX from a volatility standpoint, since I've been talking about volatility. And you can see that we are breaking down below that 15 level, which means that we are highly likely heading back down towards that 12.5 level, which was support before Yen Monday. That's where we had been for the better part of the year or so. Was the lower end of the VIX range. Then we had Yen Monday, and as you know, we've talked about this numerous times. The trading range changed and went from 15 up to 22.5, and 22.5 every time the VIX got there. We bounced back down. Then we came down. Looked like we were going to try to hold 15, maybe have a little more increased volatility, and then just rolled over at the 50-day moving average. And so now we appear to be headed for that 12.5 level. That's where I find a little bit of interest moving into the end of the year and talking about how we could have added volatility with lower volume. Who knows? There's no real way to know that I'm aware of how many investment managers have actually hit their benchmark. So how low will the volume be into the end of the year? It just depends on how many are chasing performance and how many have achieved their bonus levels. But to move down to 12.5, do we break that into the end of the year? We're still early. We haven't even gotten to Black Friday yet. And we are going to talk more about Black Friday. You saw that on the open. It's going to tie into the case study consideration that we're going to have for today. And by the way, thanks for the comments on the U.S. market update. For those of you that followed the case study last week on MARA, M-A-R-A, that was as someone said, that was a home run. That was a good one. Let's see if we can duplicate that this week. All right, so we'll see what happens to the VIX once it gets down here to 12.5, which it does seem like it wants to go down there with President Trump talking about the tariffs. We could have had a little bit more volatility today, but so far not. Let's see what the bond market has to say about this. Let's take a look at TLT, and we'll get an idea. Here's that move I was talking about that occurred yesterday, where yields actually dropped for the first time in a while. Remember that the TLT is pricing and yields move in inverse proportion. So with this move to the downside here in price, that meant yields were going up, but then a big jump up yesterday in pricing. And so yields dropped for the first time in quite some time. It's been since this B wave correction back in October since we've really had any significant move down in rates. Everything's been moving up since then. But we got a little bit overbought, a little bit away from the 10-day moving average, got up near the 50-day moving average. It would be really interesting if we broke above this level here. That would mean that zigzag pattern is indeed over, which it does look like it is from that big move up yesterday. Usually don't get jumps like that and then continue lower. So it does seem like that 100% extension is the end of this zigzag. Remember, with the B wave at 38.2, you look for a 61.8% extension. And then if you have a further extended C wave, you go down to the next fib level, which is 100%. And that's where we hung out for a while with TLT. This bounce back up, I think, means that it's very likely that zigzag is over. If it is, then we should retrace back to the B. Normally, when a zigzag ends, the C wave extension gets retraced. So that could mean further movements to the upside in pricing and further down in yields. That would be supportive of the market moving higher, which is quite interesting. The market had the big Trump bounce following the election, the Trump bump, as the media has labeled it. Then we had a little bit of consolidation, and we seem to be staying in the upper end of that pennant pattern. So at least a little more constructive on the bond market now. And let's take a look at the dollar. The dollar had gotten quite strong, as you know, was starting to get a little concerning as how strong it was. It backed off a little bit with the fact that rates were coming down, which you would imagine, but we're well outside of the range that I thought we'd stay in the dollar. I would prefer that if we stayed below the 105 level, just kind of in a trading range between 100 and 105 would have been very constructive, I think. If we get too high in the dollar, again, we've talked about this numerous times, it becomes difficult for companies when they report earnings because most companies are international now, and then they have the exchange rates to deal with, et cetera. So when the dollar gets too strong, it affects the bottom line on earnings. But backing off a little bit on the dollar, which is good to see. Now the question is, how far down do we come? We're in a wave 3 here on the dollar, which again is worrisome. If we turn and move back to the upside, that would likely mean that rates have turned and gone back to the upside. The TLT doesn't seem to be showing that. Let's take a look. We haven't looked at the TNX in a while, which is what we looked at for quite some time for the bond market. It's kind of moved to the TLT, the 20 years, kind of a midpoint range. But you can see here, remember now, TNX is actually rates. So the TLT shows pricing, the TNX shows rates. And so with that movement to the upside in pricing yesterday, that was a move to the downside in yields on TNX. This is a LE wave pattern that shows that if this had been a valid pattern, we would continue lower. But because that wave 4 is at 83%, that is an invalid LE wave pattern. So you don't even look at it. You just turn the button off. And we have to wait and see how this plays out from an impulse standpoint. You let the new impulse pattern become clear. The only thing I can see here is one big long impulse. This was a little bit of a corrective move. And then to the upside, now we'll see how far down we come here in rates. So if the TLT goes higher, prices go higher, you would think that rates would come lower on a TNX, perhaps down to the 50-day moving average, and then we'll see if we can move lower from there. But still pretty interesting things going on in the bond market. It is cooperating a little bit more with the TLT and the TNX, et cetera, rates across the board as far as not so worried about the import inflation. That's the big consideration. There's been some commentary about that, on disagreements on how much tariffs actually play into it. Some people are playing the middle road, saying that, well, it depends on how big the tariffs are. Just tariffs themselves don't import inflation. It would have to be significant tariffs to really import inflation. I think that's just trying to play the middle ground. Any tariffs, I think, are causing prices that come in to be a little higher. It's inflationary. Now, we can argue to the degree of inflation, but I don't think there's an argument on whether or not tariffs import inflation. It just seems, just by the very definition, that they do, because prices will be higher unless companies in other countries decide that they're going to lower their prices because of the tariffs to make their goods more attractive. And I just don't think they'll do that. My opinion, I could be wrong. It's going to take some time for all this to play out. We're still in November, so we have to wait for the new administration to get in, for those things to be enacted. Trump says he's going to do it right away as soon as he's in office. So sometime around mid-January, we should start to see how the market's going to react, because we should know the exact numbers of what the tariffs are going to be. What he was talking about yesterday was pretty significant, which is following through with what he said on the campaign trail. But a lot of people believe that when it actually comes time to put pen to paper, as the expression goes, that perhaps the tariffs won't be quite as strong as what he's been talking, quite as high, and maybe not as much to worry about. But we're just going to have to wait. It's going to be pure speculation on it between now and when the administration actually takes office. Let's take a look at what some of the other markets are doing. If we look at the DIA, kind of a new bid back into the DIA. I'll turn the LA wave button back on. You can see we're in a wave 5 here. It's already extended. It's past 100%, which means the corrective move would not be expected to go back down to the previous 4. Remember, if the wave 5 extends more than 100%, you look for a 61.8% corrective move. Clearly a zigzag here. Hopefully y'all are seeing these things now and see them even before I point them out. But a B wave right around 50% would yield 100% extension, which should bring the DIA up to the 455 or so range. We got a little bit overbought yesterday from where we were with the 10-day moving average. You can see that bounce up. And so a little bit of consolidation today is warranted. We take a look at the Qs. Still underperforming the other markets, but hanging in there pretty well. And Of course, we had a little bit of a bounce yesterday with the drop in rates. That was helpful. We do have a wave 4 labeled here, but it hasn't even made it past the 23% fib level yet. For those of you that may be newer, I talk about this a lot. I've read pretty much everything Ralph Nelson Elliott has ever written because I like the Elliott wave algorithm, and I think you want to look at the horse's mouth or listen to what the person that created it has to say about it. And he would acknowledge the 23.6% level is a fib level. That's why the wave 4 is labeled there. But he always preferred a corrective move to go to at least the 30% level, if not all the way to 38.2. His viewpoint is that there are times when if you come down here and you only go to this first fib level, that could relabel. In other words, if we take out this wave 3 high, the 3 could move over here, the 4 disappear and the 3 move over here, and this be a continued 3. So I'm going to be very interested if the Qs are able to take out this wave 3 high, which is close as we are now, seems like that's likely. Will the algorithm label this new move as a 3 continuation or a 5? So if it labels it as a 5, then that wave 4 will turn blue or purple, blue or purple, whatever. And the wave 4 would be in, and we would be in a wave 5. But until that occurs, we have to be suspect on whether or not this is the end of the corrective move or if we're going to have a wave 3 higher. So there's just going to be a lot of interesting things go on between now and the end of the year. Again, I don't have a feel for how many advisors will be taking or investment managers will be taking the rest of the year off, but that is how it works. They don't want to risk if they've already hit their benchmark and they've already outperformed the S&P. They don't want to risk going backwards and having a bad December and losing their bonuses. So a big key tied there. Now, I wanted to look at the IWM. I do think this could be an area to watch. It seems to be conducive to some of the policies that are going to be put in place with the new administration. So small caps could be a very interesting place to watch. Yesterday, we had a peak on this wave 3 after a couple vertical days. You can see that we just got too far from that 10-day moving average. You know the rule. No security in any time frame gets too far from the 10-day moving average. So we came down and closed near the lows, and then a little bit of give back today. But all that is just correcting the overbought condition. That's not a negative in any way, shape, or form. So I do think that the Russell is going to be a quite interesting place to look. I like the fact that we're backing off a little bit here. So perhaps we're going to get an opportunity, pardon me, to trade the Russell. If not between now and the end of the year, perhaps at the beginning of next year. So right here on this B wave, right at the 61.8% level, that brings the C wave extension. You know that I love it when a B wave is right at the 61.8% level. Wave 4 for that matter as well. I think the 61.8% level is the strongest of all fib levels. So I think there's a high likelihood that the Russell is going to continue up, pardon me, to that 250 level. And once we get there, then we'll wait and see where things can go from there. But we do need to do a little more backing and filling here, allow that 10-day moving average to catch up following these big 3 vertical days. So far, we're holding right at the top of that A-wave impulse. You do want to see that. If you are long the Russell or wanting to see the Russell go higher, you want to see that hold there and see if we can continue up to that C-wave extension. So pretty interesting right there on the IWM. I do think it's a place that once we finish this backing and filling that you could look for an extended trade. So when we see that, we do want to check the DMI and let's see what it's looking like. And it's starting to set up. We're not there yet. So we want to see that ADX continue higher. We need that ADX to get above 20. It's not there yet. We still have the opportunity for that ADX to roll over. So another reason why we kind of want to wait and see if we do some more backing and filling and then resume the upward move. We need that negative directional indicator to head back down as well. Kind of interesting that just with a little bit of give back from a 3-day vertical move, that just on that move, we had a little tick up in the negative directional indicator. That's a little surprising to me. I thought it would be a little more neutral. So the DMI is not quite set up to show that we're going to that 100% level yet as far as confirming the move. But, we'll continue to watch it each day and see what happens as the trading days move on and whether or not that continues to the upside or not. Let's take a look at the metals, looking at GLD, and you can see that we are in a zigzag to the downside. But take the DMI off. I don't look at it as much on downward moves. And if you're wondering why, the DMI tends to be a touch more of a lagging indicator, and things can move down so quickly that by the time the DMI catches up, the move might be over. So I like to look at the CCI, which is more responsive to day-to-day movements on downward moves. And so we are ticking lower here. Perhaps that means that we are going to move lower in the metals. And we came down below that midpoint. So we had gotten below negative 100. That was a pretty oversold condition there. Normally, the CCI works between these two levels, 100 and negative 100. They can get above or beyond it, and that usually means that you're kind of running out of steam, whichever direction it is. Same thing happened on that first impulse move to the downside. You can see how far down the CCI went. Then we retraced back up to 100. And that's normally what happens if you're going to get a continuation of the current pattern. So with that zigzag in mind, we could possibly continue lower here, see if we get down to the 100% extension or not. But we went right to a 50% corrective move and then reversed and headed back down. We are below the 50-day moving average. And until we can recover back above all the major moving averages, I think you have to lean a little bearish on GLD. Let's take a look at silver and see how silver is doing. And it's kind of still hovering down at that wave 4 level, right at the 61.8% fib level. It moved over just a little bit, but not much, as you can see. Still at an area where we could see silver take off to the upside. Wondering if silver plays catch up to gold, but we would have to have gold turn and move higher and not complete its downward zigzag if we're going to see SLV turn and move up to 161.8. We'll have to see how that plays out. But for now, SLV is still lagging just a little bit. And if the Qs catch a bid, a lot of people view silver as being tied to the technology sector due to the fact that a lot of technology uses silver. And if the Qs are going to move up, why wouldn't the SLV move up unless that GLD move continues lower? Then SLV will probably follow it. But for now, you just keep a close eye on this level right where we are here on SLV at this 61.8% corrective move and see if we can bounce. If you're itching to go long silver, which I imagine a lot of you are, I am as well, we have to get back above these major moving averages, in my opinion. So I think you sit on your hands and wait. We would want to see a move back above that 50-day moving average to consider going long SLV. So for now, we continue to monitor it, holding that wave 4 corrective level. Taking a look at oil, I've mentioned this numerous times. I feel like oil is going to move into a big trading range because I think there's going to be dueling issues going on now between the U.S. and the Middle East. The whole drill, baby, drill thing with domestic production likely to increase. That just means further drilling. I know some of you have mentioned in the U.S. market update, well, I thought we were already producing a lot domestically. Well, yeah, but this is the idea of new wells, new drilling going on. And companies will not initiate any new drilling unless oil is above $35 a barrel because they can't make any money. It has to be above that, and it's well above that. So I don't see any reason why we're not going to have increased domestic production, especially when Trump says he's going to set the regulations to where it makes it easier. But I don't think that the Middle East is going to allow prices to continue to go down. In other words, I don't think they're going to pump as much if we're creating extra supply I think they're going to try to match that. So with whatever extra supply we create domestically, I think there's a high likelihood that OPEC backs off their production to try to hold these prices in here. I've covered this a bunch of times as well, that the Middle East has realized that they have limited amount. They've done their geological surveys in the ground, and they want to make as much money as they can with what they have left. And I just don't think we're going to see a big significant move lower in oil. We do have this triangle, and if we break to the upside, I think we bump our heads at 77.5, and we'll see if that holds as resistance. If we break to the downside out of this triangle, then we have support just under 67.5. And what I think is going to happen until it shows me differently is that even with this breakout, we'll either hit resistance up here if it's an upward breakout, or we'll hit support down here if it's a downward breakout. But I think in general terms, the likely scenario is a big trading range here between these two levels. I think that's where oil is going to live for a while as we go through and see what's going to happen with domestic production here in the U.S. And then let's look at UNG. You asked about it on the U.S. market update. To look at it again, if you were watching football last Sunday or last Thursday, you saw a big snowstorm up north, and we talked about this to our insiders meeting members. That's our subscriber meeting only for alert subscribers, that the Farmer's Almanac had said some areas of the country were going to have a pretty difficult winter, but overall, it's viewed to be a fairly mild winter. But we did get a bounce up with that big snowstorm. So that did create a bid, which made it interesting. We've been looking at UNG for quite some time, kind of took it off the list for a couple of weeks because it just wasn't doing anything. But with that snowstorm last week, we did get a bounce up back to that B wave. So this C wave is complete. The B wave at 38.2 gives you a 61.8% extension. We hung down there for a while. And then when a zigzag ends, as I talked about earlier, you retrace the C wave. We've already done that. So all the rules regarding this downward zigzag have been hit. So that zigzag's complete. We've retraced the C wave. Again, wait and see. So not really a place to try to initiate a new trade on UNG. If you're long, I don't see any reason to get out. If you're looking for an entry, I wouldn't get in yet either. Let's see what happens here with this 15 level. And I think where the real bid could come in, this is what I'm going to be looking at as far as a trade on UNG, is if we can break above this 0 point where the start of that downward zigzag occurred. So right in this area, if we can break above this line here, then I think you have a long trade on UNG up to the 20 level. So that's where I think the trade would lie if we can break above this level. So it's too close to it. I don't think it warrants putting on a position from a risk to reward standpoint. If you're super aggressive, you probably get a bounce up to that level. I would think it would come up and at least test it with this move higher here. But if you're more conservative, and I usually try to give both a conservative and aggressive view, we all have our own risk tolerances. You know what yours are. If you're more conservative, then just kind of wait, see if we break above this trend line here, break above resistance, and then you have a long trade probably up to the 20 level. So we'll continue to monitor that. All right, so let's get to the crypto world. Looking at Bitcoin, backing off just a little bit as we ran up to that 100,000 area. We didn't quite hit it, but we got close. And then we've backed down, trading just below the 10-day moving average. And we'll see if we can find a little bit of support in here. There's congestion right here from the election. And then we tried to take another run, and then some movement back to the downside, which I think was really warranted following that big run. Consolidate just a bit here. Don't want to give up too much of it if you're long Bitcoin, but a little bit of backing is warranted here. I think nothing goes straight up forever, as you know, and I just don't think that we were just taking off on Bitcoin. So we've had a big move higher. All the crypto people are excited about a crypto-friendly administration coming in, and so it does seem like future for crypto, at least over the next few years, is going to be pretty strong. But that was a really big move from the 65, 70,000 level up till nearly 100. So again, backing and filling warranted. So maybe it calms down just a bit with what's going on in Bitcoin. Ethereum had a nice move yesterday, but then came back out off of the highs and off those highs. We've held the 10-day moving average for now. Thought that Ethereum would likely play some catch up as it wasn't moving quite as strongly as Bitcoin is. So the movement would tend to drag it along a bit. That seems to be playing out. We do have a nice zigzag pattern, as you can see here. And we ran into resistance at that A-wave impulse right around the 3,500 level. So where does it go? Well, with a 38.2% B-wave correction, you would look for Ethereum to come up here to this 61.8% extension. And then once again, if we get there, then we bring the DMI in to see what's the likelihood to have a further extended C wave. But the rules are a B wave correction at 38.2 yields a C wave extension at 61.8. So I think that's where we go with Ethereum. And then as we add in Solana, which really took off for a while, has backed off a bit as well. Chart looks pretty darn similar to the Bitcoin chart with this movement back down. You know how the triangle rules work. When you have a breakout, you oftentimes highly likely to come back to the point of the breakout and test that. And that seems to be what Solana's doing. So coming back down here, can we hold this midpoint for a potential turn back to the upside? If you're long Solana, you're like, all right, we're breaking below the 10-day moving average. Let's turn and get back above that. So if we can get back above that in the near term, then Solana could go higher. But for now, once again, backing and filling from the big move and likely testing. Even though this was a small triangle, the rules still apply. You still usually come back and test the point of that, and we're kind of right there, just a little bit above it. So maybe a little bit of calming in the crypto world now, following that acceleration from the election. And then we'll see where we go from there. Let's take a look at a few of the international markets as well. EWA, as you know, Australia is very resource rich. Talked about this. It tends to move a lot with gold. Not so much right now. We've created this large ascending triangle here with the top part right at the 26 and a quarter range, just below 26 and a half. We tried to sneak out of it, but we're back down right at, look at all the major moving averages, at least the ones that I look at. The lime green line is the 10-day moving average. The fuchsia colored line is the 30-day. And then the royal blue line is the 50-day. They're all converging at the same spot, which is exactly where we're trading right now. So a little bit of a peek your head out for a potential upward breakout, and then not so fast, back down into the ascending triangle that's formed. And as you've heard me say numerous times as well, just because it's an ascending triangle, don't make the assumption that it's going higher. I think that the EWA could break to the downside if gold breaks lower and continues on that C wave extension to the downside. So a little bit of wait and see on the EWA as well. So you can see that from a lot of the patterns we're looking at, consolidation is the key right now, and let the market give us what the new impulse pattern is going to be. And you can see that with that zigzag that completed. I talked about these rules a couple times already. When the C wave ends, when the zigzag ends, you retrace the C wave. Well, we did that with the EWA. So we retraced that C wave, and for now, that level has held. And now we look to see which way we're going to break from this ascending triangle. So we're starting a new type of impulsive pattern here, and let's see which way it goes, which way we break out from there. For our friends up north on the EWC for Canada, you can see that a little bit of a pullback today, but hanging in there pretty well. Again, completion of that C wave extension got right to 30%. Didn't even make it to 38.2, but that would yield a 61.8% extension. and we traded there for over a week, almost 2 weeks of trading, tried to break above it. Now we're back testing it. If you're long the Canadian market, you want to see this C level hold at 42. So you want to see the market hold that level at 42 before potentially turning and moving up to that 100% extension. If we break below that, well, then we have to start to look to see, well, is this a corrective move? Are we forming a zigzag? What's going on? So we have to kind of wait on that as well. But if you are long the Canadian market, I think you stay long as the EWC stays above that 42 level. And then the INDA that we've been talking about so often with the levels, we have been pretty darn spot on this one. We said if we broke 57, we're going to 55. We broke that, we're going to 53. All that played out exactly as you would draw it up. We've gotten a bounce off that 53 level, but since 55 was support, it's now resistance. And we have to have that, the Missouri thing that I talk about a lot. Another one of my analogies, show me. We got to see the INDA, in my opinion, get back above 55. And oh, by the way, the 50-day moving average is right there. So we need to break above 55 and the 50-day moving average. We can get above both of those. Then perhaps we have something going on again in the INDA. Maybe we're going to start a new impulsive move to the upside with that wave 5 above 100%. We were only looking for a 61.8% correction. That happens to coincide with where that line is at 53, which is why we felt like 53 would be the next level. So that entire pattern has completed itself, again, exactly following Elliott wave rules. But once again, the theme of today, let's wait and see what the new impulse pattern is. So what you're seeing play out here, I think, in the markets in general, is we had the big move following the election. A lot of things are getting consolidated. There's a lot of backing and filling going on following those big runs that we had at the end of the election. And then we have to see where things go from here. And it is going to be pretty interesting when we have all these patterns that need backing and filling, which would imply sideways moves. You don't get a whole lot of that with low volume. You might think, okay, well, with low volume comes low volatility. And I already explained, not necessarily. It could be. You could have low volume and low volatility, and that would imply a creep to the upside. But we've seen it before, where during this time frame with the lower volume, you can get outsized volatility moves. So that's what we'll wait and see how that works on the INDA. Let's go ahead and look at the EWG. We'll take a look at Germany real quick to see what's going on across the pond. As they say, we had this move down once again, following all the rules to a T. The zigzag pattern completed, retrace that C wave. We did right back to where the B was. Once again, 38.2% B wave correction is going to give you a 61% extension. Exactly what happened. Then we went into a complex move with the triangle. We broke to the downside to complete that retracement. So here we have to wait and see again what's going to go on there. You may or may not be aware they're a little bit ahead of us in the rate cutting cycle. And that's kind of what's been tying in. And that's why rates were staying higher, I believe, in the U.S. Is due to the fact that there's a chance that the Fed, at least if you believe what they've been saying, may not cut. I think the Fed wants to wait and see how big are these tariffs going to be? How inflationary are they going to be? And there was at one time where 25 basis points was, I think it was 100% in the Fed fund futures that we're going to get one more 25 basis point cut in December, and then they were going to pause. But now some of the Fed governors have been coming out and saying, it's not a done deal that we're doing the December cut. They're leaving that open as perhaps they don't cut in December. If they don't, gosh, that could be wild. If they don't cut at the December meeting and we're in that lower volume time, we could get some increased volatility and maybe some significant downside moves if that's disappointing to the market. So that's an area to watch. That December Fed meeting and whether or not they cut or not could play in a lot. FXI, remember that David Tebber came out, buy all things China, and that looked like a great move to make until Trump won the election. And then the tariffs that he's talking about just put an end to that trade. and we went into this consolidating triangle. You can see we're trying to sneak out to the bottom of it. We're right at an area in the neighborhood of the 61.8% fib level correction. If China is going to resume back to the upside, that wave 4 needs to hold here. If we break any lower, I think, in the FXI, then you have to say that that 5-wave pattern is over, and it's highly likely that we're going to see the FXI back down here in this area around 25.5 or 26, somewhere in that level, back here to where we started this impulse move. And that could tie in exactly with a downside breakout from the triangle. That's about where you would expect it to move. And so at this point, it hasn't been the classic triangle breakout with follow through, but it's trying to creep in that way. And so it's hard to see where the catalyst is going to be for a while on China now until the Trump administration gets in and we find out what those tariffs actually are going to be. So that's a tricky one to trade right now, the FXI. I think you just have to, once again, wait and see how things play out. So taking a look at our past case studies and the MARA one that we did last week, we said it was going to 25 and it blew above that. So those of you that followed it had a really nice quick trade. It took off right after we did TradeFinder last week. So nice move there. Hopefully you all followed that one and had a nice trade. I know some of you did because of your comments, and we'll look and see if we can't do something pretty similar with this week's case study consideration. And as a reminder, once I go through it, which I will here in just a moment, what we're going to be looking at for this week, Zach will come in at the end and show you how to post it. Another one of the great features of the software. And if you've been under a rock somewhere and haven't gone and gotten a copy of the software, go to hub.com, hubb.com, get the software. You get free Elliott Wave, you get free intraday Elliott Wave charts, and there's an opportunity to, from a subscription standpoint, get the AI signals too, if you'd like to do that. But for now, you can just go there and follow along with what we're talking about each and every week here. So we're down testing the 25 level. We bounced off of it. We got a little bit ahead of ourselves. You can see with this move, they got above 27.5, too far away from the 10-day moving average. We need that to come back down, which we've been doing the past couple of days, having the low right around 25. As long as that holds, I think you can stay long here, which would imply that Bitcoin probably goes higher after its consolidation, but we'll see. But for now, that's the area that we're in. We'll see if the 10-day moving average can catch up here, and then we can have another run. But for now, it seems maybe we pause a bit, but the way the whole crypto community has been acting, I'm pretty excited about a crypto-friendly administration pretty much across the board with what's been put in place. And I thought I would go back and look at TLT again, because some people were crediting Trump's announcement for Treasury Secretary as another part of the reason why we got this big bounce up in pricing yesterday in the bond market. They view that selection pretty favorably, at least the pundits in the whole bond market side of things seem to think that the bond market reacted positively to that appointment. All right, so with that, let's go ahead and take a look at what we're going to be looking at for this week's case study consideration in honor of Black Friday and the pattern itself. We're going to look at the XRT, which is the retail sector. This is the height of retail season, right? Black Friday starts it, the holiday season buying. Yesterday, we got a little too high there. But you can see we've pulled back a little bit today, which is nice because we don't want to chase that move. And this is why we talk about that. No security any time frame gets too far from the 10-day moving average. Once they get that separation, then they come back down. And it either is a combination of moving back to the 10-day moving average, going sideways and allowing the 10-day moving average to catch up, or a combination of the two. But you get back to the 10-day moving average at some point. And now the only question is, would the XRT come down and fill that gap? Maybe, but we'll take that, and we'll take that chance at this time of the year. And obviously, when we start to get the early numbers from Black Friday sales, you've seen it. You've all seen the advertising. Companies already have all their Black Friday deals out. They're starting early. They're not waiting for Friday anymore. They just start them early. And so I'm sure you've been bombarded with specials as well. We'll trade this. We've got a nice wave 3 here. If we look at the DMI, that looks awfully constructive. This is what you want. See how that ADX is broken above 20. It's above the negative directional indicator. Great separation between the positive and negative directional indicators. So it looks like we want to continue higher in the XRT. We wouldn't be too concerned if we come down a little bit more for the next day or two as we allow the 10-day moving average to catch up. But sometimes you don't get the perfect entries, and you don't want to wait. I've talked about this before. One of my early days of trading, I read a book of the top 10 trader mistakes, and one of them is trying to wait for the perfect entry, trying to be too careful on getting in, and you wait too long, and then you miss the move completely. So we don't want to do that. So there's lots of open interest. We can bring up the options chain here on XRT, and you can see, we don't want to mess around with November weeklies, and we go into December. We come down here. We can look at the January monthly. Would be a consideration. You could even go further out if you wanted to, and turn the volume off. I like to look at Delta, but open interest, you can see on some of the strikes is pretty good, and plenty to choose from there as far as whether you're looking in the money or out of the money. 40 Delta is the low there. I'm going to add in a few extra strikes, and we can go down and look at deltas that are a little bit lower than that, but you can see what happens with the open interest. So we would look probably around this 85 call, 467 contracts. That's pretty good. And if you wanted to, you could actually come down and do this March monthly if you wanted a little extra time. And there's some open interest on varying strikes there. But the one that would interest me is coming down towards this. You can see the 47 Delta, but that's the at the money option. I don't like trading at the money options. There's way too much extrinsic value priced into at the money options because that's where the average retail trader trades. So I like to go a little further out of the money, get a better delta gamma relationship. And you can see coming down to the 87 strike as a 39 Delta, over 1,000 contracts, 1,500 contracts. So pretty good open interest there, decent spread. If you would like to have a little more time in the trade, perhaps that's a strike to look at, the March 87. But nonetheless, that's what we'll be looking at with the case study consideration on XRT. So I was giving you an advanced look. If you haven't gotten the software yet, the option functionality is going to be released very soon. Everybody's excited about that has it. So I thought I'd just give you a quick taste of it. Beta testing it. Looking for any sort of bugs. They don't want to play the old Microsoft game at the hub organization where you just release a new software and then wait for all the people using it to find the bugs and then send out 1,000 patches. They try to do the due diligence ahead of time and have it as close to no bugs or bug free as they can possibly be when it's released. And so I think anyone that's ever dealt with that is happy about that modus operandi, if you will. So that's it, Zach. Take a few questions now before you come in to show people how to put that in.
Sounds like a plan, Rob. I think you're going to start out with Starbucks, SBUX for Trade Simple. I'm sure they will see some sales over this holiday season.
Would think so, with all the shoppers out. Probably need a little caffeine to keep going, fighting the crowds, etc. Although not as bad as it used to be since so much is done online, but still think that agree with you in wintertime, whatever the motive is. Pretty interesting that we tried to get above And this is one of those other rules, right? When you break a major point of support resistance, moving average, break out of a triangle, etc., the first day doesn't count. You have to have a follow through or confirmation day because the market loves to do head fakes. It loves to try to fake out the weak hands in the retail trading side. And so we broke up, but then we didn't have a follow through day yesterday. And so now today we're back down at 100. So as long as we can hold this 100 level, I think you can try to stay long Starbucks if you're in it. If you're waiting for an entry, let's let it get back above 100 on a closing basis because we could still close below this 100 level. But for now, we're holding that wave 3 impulse high. It's only a 35% extension, so maybe we continue higher. But 100 is going to be key for Starbucks. Another argument could be, all right, well, it broke out and now it's just testing it. Maybe that may be what's going on. But I would have felt better if we would have had a follow through day yesterday and then come back to test it. So 100 is key on Starbucks. If it breaks back below that, then I think you have to get out of that one. It shouldn't be too much from a risk standpoint because there's a ton of congestion right in this level here around the 98 level. So even if it breaks 100, I don't think it goes down too far, at least for now. It's got a lot of area of support here. So we'll see how it handles this little corridor between 98 and 100, but I do think 100 is the key level. All right, next.
Thanks, Rob. A couple of symbols from Manuel. First one's going to be SFM.
Sprouts Farmers Market. Haven't looked at that one in a while. Nice little zigzag there in the wave 3. Interesting. Looks like some people are health conscious here, and nice move right to 30% level. So that gives us a little more to the upside here, up into that 160 range. And then we would want to look at the DMI. Now, this is pretty interesting. A nice little tidbit here on the DMI as the ADX breaks higher, and it's up at 60, which is pretty high. Sometimes once you get up there, you start to roll over. And when the ADX rolls over and breaks back below 40, that tells you that move is over. But there are times when the ADX does exactly what's occurring here, and it kind of goes sideways, which means this move up, the entire move up from the B wave completion to where we are now has been strong. So this has been a pretty strong move. It's not showing signs of FOMO that today's move is, they fear missing out. It looks like this wants to continue higher. And we'll have to see once it reaches that 61.8% level, then we'll come back to the DMI, see if that ADX is remaining strong. But you can see that we're getting the renewed separation between the two directional indicators, positive going up, negative going down. There's nothing here that looks like this move is done, even though the ADX is so high. It looks like it's just a pretty strong move, which is a little surprising, honestly, for this sector. It doesn't seem like we're worried too much about a recession with stock like this going to the upside. People tend to back off of more expensive purchases, and usually when you're buying more quality food, it costs a little bit more, organic, etc. And your own beliefs on whether it's worth paying more for good quality food or just processed stuff. So everybody has their own. I'm not going to get on that soapbox, but it looks like that wants to go higher. Next one.
Next up, we have LLY.
Eli Lilly. This has been, the place to be for a while. And then we had the big move to the downside. So we got up, and it was kind of hard to imagine that we would get up this close to that big 1,000 level and not make it, but we didn't. We went sideways for a while. And now we have a qualified 5-wave to the downside pattern, which is pretty interesting. And all that changed on election night. As you can see, we had this movement down with the election, not as much interest in the defensive side of things, which Eli Lilly tends to be, but a great company. And perhaps if you're looking for an entry here, We held 750, which is a nice move lower from where we were up at 950. So we've pulled back quite a bit. It is labeled as a wave 3 to the downside. Perhaps we're bouncing up in the wave 4 now. I think this one looks interesting, at least up to the 50-day moving average. And then if we're going to get up that high, are we going to come up and fill this gap? But with that said, your stop is the 750 level. If it breaks below that, you got to get out, because that means that the wave 3 is either heading lower, or we're going to label a 4 up here somewhere and then head lower in a wave 5. But for now, I think you could get a little continuation on a further bounce up to test the 50-day moving average, and then we'll go from there. There's resistance at 850 even before we get up to where this gap is. But once again, break below 750, and you need to exit that from a long side. Couple more.
Thanks, Rob. Let's check out what's going on with AMD for Irv.
Good old AMD. Been a lot of comments about and questions about AMD. It disappeared for a while with all the other stuff that was going on, and now people are looking at it again. So we are moving down today. As you can see, we had this zigzag pattern, the B wave right around 61.8. That gives you the 100% extension. We did it. We didn't quite make it back to the 61.8, and usually those lines get touched, and you can say, well, gosh, you got awfully close. And it did, but usually you touch those lines before you go down to the next level. And that was what you would think is going on, that AMD is going to work its way down towards that 161.8% extension. We're at 137 now. I think there's a pretty good likelihood that we do see that 130 level. What would change my mind is if we could get back above where this 100% extension line is, which is like 142, with a follow-through day. Then you could say, okay, I feel like I can go long again AMD, but for now, I don't see, I think risk to reward, you don't want to go long AMD yet, and perhaps it's even a short down towards the 130 level. That's going to be really interesting to see how it plays out. At 130, I think it would be very, very interesting. So if AMD did make it down to that 130 level, I think that could be a long entry. But I wouldn't go long right now, not till we get back above 142 with a follow-through day. And the higher likelihood is that we continue just a bit lower here on AMD.
Duly noted. We'll do one more symbol and head over to the platform to post the idea. Let's go ahead and look at CELH for Sean.
Good old Celsius. And take a look here at this wave 3 to the downside. I think we looked at this one in the past and said, gosh, that's a pretty ugly looking chart. The wave 3 is trying to hold right there at the 161.8% extension of this zigzag that we had back here, which is a very extended zigzag pattern, because the B wave was only at, call it the 38.2% fib level. So that takes you to 106, or it takes you to 61.8, which is where we traded for a while. And if it breaks that, you go down to 100, which it did. That's the extended level. And it went sideways for a while and then broke down again, which that's the next level, the next fib level. That's these fib levels work as you've seen it, amazing areas of support and resistance. And so 161.8 would have been the next target. And there we are. So we got a little bit of a bounce, but we bumped our head on the 50-day moving average and rolled over again today. Gosh, could it break that 161.8? Maybe it's going to come down and test it again. It seems that way. If we close below that 10-day moving average, it does feel like it wants to come back and test that level again. If it does break it, then I think it could be a short. But for now, it's a pretty difficult trade at this point, because we're right between this 161.8% extension and the 50-day moving average, with the 10-day moving average right in between. So some more of this sideways stuff may be warranted here. If not, a drift back down towards 25. So if you're looking to go long here, you've got to wait for that to get above the, in my opinion, the 50-day moving average before you would even consider going long. And if you're going short, then watch what happens when it hits 25. But to go long, get above 30 with follow through, and then perhaps we could have some more room to run to the upside, at least back to this 100% extension, which would then act as resistance. But for now, this doesn't look too positive for a short-term move higher on this one, if that's what we're looking for. All right, let's go back and look again at XRT and take it away, Zach.
Sounds like a plan. Yeah, let's head over to the platform, or did you want to go back over your analysis there?
No, go ahead. I was just bringing it up while you talk people through it.
Gotcha. Following along, no worries. I did want to pass through that Angelo and Maria said that you sound better, and they send you their well wishes. So I don't want to keep anyone. Yeah, we greatly appreciate that. And I don't want to keep anyone past the hour that they signed up for, especially in this holiday shortened week. So I won't spend too much time going through other parts of the platform for today's session, but I will show us how to get to the ideas here. Clicking on the all ideas will bring you to a hub of all of the community ideas that have been submitted. And as we've gone over in the past, you can go in and interact as we encourage, whether you agree or disagree. Opposing opinions is what makes markets. If everyone agreed, there'd be no transaction or trade to occur. So we're always interested to hear your feedback. We're going to go up here to the light bulb, which will be the option to create an idea or a post. An idea, as we're going to do today, will be an official idea that you'll see with real-time data. You can equate it to paper trading with all of the same info again and data that you would have if you were paper trading for another brokerage. And a post is more of a discussion board forum. So here we are at the new community idea. It's going to be on XRT. Search that in the symbol box here. That's on the NAS. We will go over to the target price. What was the target price on that one, Rob?
86.
86. And the time frame?
Show them the 2 month. That should be enough time at this time of the year, because we're kind of playing into that retail holiday shopping.
Yes, indeed. I like that call there. And just so everyone could see, I did hit custom down here at the bottom. There are these fixed intervals of time that you can select if the time frame you're looking for happens to be one of these. However, as we're doing here, you can go to custom and go to the very specific day that you want the trade to expire. So we're here in November 26th. We'll go over to 2 months, which brings us to January 26th, which is a Sunday. I always like to go to the first trading day here, so that'll be the 27th. This will be made pretty here very shortly, but again, I'm going to go ahead and post this for everyone to interact as we are live in this session now. And again, whether you agree, disagree, we encourage all of your feedback. And it's whether you are on the agreeing side again or disagreeing side, that's what makes markets in general. And we love to hear any further context you have around your ideas, graphs, things along those lines, and any charts. So Rob, I'll pass back over to you and let everyone get back to their trading day.
I agree. Love the community format on the software. The fact that you can have a commentary and have a community room, etc. there, post your own ideas, agree, disagree. It's always fun to post an idea and see what other people think of it. And we have a very respectful community on the platform. So you can disagree and do it in a very diplomatic way, if you will, respective way of the person that had an opposing idea. And with that, thank you for your attention. Thanks for the comments. I feel better today. Not 100%, but a lot better than I was yesterday. And so hope everyone has a great holiday week. Hope you get a chance to spend some quality time with family, friends, and loved ones over the holiday. It'd be interesting to see how the market reacts on this holiday shortened week. And we'll be back to talk to you again next week. Take care, everybody.